Greetings, everybody. This is Jeff Scott. This is my top-down review for Sunday, March 7th, 2021. I entitled today, What Would Woody Say? Those who follow me for a long time, those of you who have been longtime users of HGSI, know who Woody is. Ian Woodward was just such a great person, trader, educator, speaker, and friend. And it would be times like this that I would be on a phone call with Ian, Manu Kapadia, may rest in peace, both of them. They're in the HGSI land in the sky. Manu, I think, just had his birthday this past week. And Bob Mager, and we'd be talking to Ian and trying to understand what's going on in the market. Somebody who I miss, and I'm sure I'm one of many who miss Ian and Manu and others that we've lost from those great Palos Verdes meetings. So without further ado, let's get rolling. My email, as you can see, is hgsidoc@gmail.com. Please hit the up or even the down thumb based upon your thoughts of this program. Maybe if enough people hit it, I'll get some YouTube marketing where it'll pop up in people's inboxes. I also appreciate the comments. Frankly, most of them are pretty positive. Sometimes I learn from the negative ones, and I appreciate those, whether you email them to me or you just put them in the comment area. As always, this is for educational purposes only. I'm a doctor, not a broker. I am independent. I've paid for the tools that I use, and trading involves risk, and you alone are solely responsible for any decisions you make. When I do educate, and I haven't done this in a while, my daytime job has become much busier than I've ever had to work before. So that impacts on my ability to have seminars. But I used to call those seminars Be Your Own Guru. I've shown you here a number of people that I've learned from, some of their books. This is Ian here, Sagar with Superior Profit in the lower right-hand corner. And then another great trader that we lost within the last year or two is George Lee in the lower left-hand corner. I've learned something from everybody here and from others as well. These are probably the ones that were the most impactful on my trading. And I use what I've learned from these people every day when I trade. So as Ian would say, I'm not a guru, but I want to teach you to become your own guru. And those were Ian's words 20 years ago. Speaking of Ian 20 years ago, I think one thing he'd be saying right now is about preserving capital. This has been a very difficult and challenging market. No, it's not as bad as last year. We didn't have the fastest decline of all time. But boy, if you, like me, had a lot of growth stocks, the HGSI doc, growth stock doc, you had felt some pain. Now, I typically hedge. So I had heavy put coverage with triple Qs, spiders, diamonds, and TNA. Unfortunately, I was at home working on Friday, and around lunchtime I was covering them because the market had a pretty dramatic reversal. We'll talk about what Monday, Tuesday, and Wednesday may bring. No one knows until Monday morning, and it may not even be what it looks like on Monday morning. But the message here is simple. We had chutes and ladders in the States. I guess in Ian's England, they had snakes and ladders. You roll the dice, you move up. If you hit the ladder, you get a boost. What a bull market. But what you don't want to do is be going up here, I'm doing great, taking off my stops, I'm on autopilot. Because if you hit that snake head, it's like a bad bear market. And before you know it, your $87 becomes $24. So don't play snakes and ladders with your retirement money. It's okay to have a speculative piece of your capital. And much of what I trade with is that piece. But it's times like this, we may be beginning a great move up, but this could also be like 2007, and I'll show you why in a little bit. I own lots of tools. Y'all have seen this before, so I'm not going to spend much time on it. The key thing is on the bottom, I'm an unpaid volunteer. This is just education. And, if you buy the tools I use because you think they'll help you, that's great. That supports the people who I bought them from, which I think is also great. So they keep making new tools, but I don't get a penny, don't want a penny. HighGrowthStock.com is my website. Under free 30-day trial, you can get what it says without even a credit card. Under investing strategy, you'll see thousands by now of videos from myself, Ron Brown, and others. So, yes, my favorite slide, which I show every week when I do this. Where are we? Well, clearly, we finally entered the sell zone. Certainly Tuesday, Wednesday, and Thursday, and up to 11:30 on Friday. So, did we just resume an uptrend one more time? We come up to stage 3 uncertainty. It feels like it's over, it's over, it's over. Then boom, we go up to new highs. Or was Friday a head fake? We'll see. I mean, with the stimulus getting closer to being passed, the House saying they'll sign off on the Senate bill, Biden says he'll sign it, maybe we get another run up. But there's a lot of countercurrents in this market that should have you a little cautious. So I had to quickly reverse from this thing on the right of bear calls, buying puts, selling calls, shorting stock and contras, and going quickly to start buying stocks and buying calls. So I shifted from 75 to the protection versus 25% long to probably 80%, 75% long, and just 25% protection. And, I use the protection as hedges. I use it because, I've been, as people listening know, I closed on one house in Jupiter, Florida. Last week, I got a house I'm building in Santa Fe, and I got a lot of taxes to pay off the money I made last year. So I've been taking cash off the table and got a little bit more defensive, which certainly helped me keep more of my money during this pullback. Speaking of amazing green days, here's Friday. And what you have here up here is the indexes, and they were all positive, the futures at least. Even the Nasdaq was up 1.5% after a really tough couple of days. If we come down here, you could see the various sector ETFs. The only thing that was red was natural gas. And then you could see materials, energy, financial, so on and so forth. And what do you see? You see green everywhere. This is what you call a sea of green. And, sometimes a sea of green like this is how you reverse a downtrending market. Didn't get all the signals I would have liked to have seen. And I'm still a little skeptical, but what a strong day on Friday. Let's take a look at the major markets here. Let's open this one up. Now, I like doing the same thing every day and every week when I do these. And so let's just analyze or look at this E-minis for a few minutes. So these are the S&P futures. This here represented, I believe, the high of last year. So you can see the low of last year came in on March 23rd. And then these are Fibonacci extensions, 23.6, 38.2, and 50%. And in green is a 17-day simple, yellow is a 50-day simple, red's a 200. So if you look at the S&P 500, it broke major rally up until September, sideways move, and then a breakout, and then a nice run up here to the high in the market, all-time high, that occurred really almost a month ago. And over the last month, the S&P and the other indexes has been basically slowly rolling over. Now, if I want to be bullish, look at this. We had a near retest of the Thursday lows and a rocket closing near the highs, breaking above the 50-day moving average. And so we're going higher. That would be the bullish feeling. If I want to be a little bit more bearish, I could say, gee, we're still at a person sell signal. We have not taken out the prior highs. And we're in an area that looks like we're stalling. And, you could start to think about drawing lines soon that we're going to have to break a descending trend line before we're all free and clear. So, yes, this looks great. Friday's recovery was on high volume, and it wasn't a triple witching or quadruple witching day. Thursday's decline also on high volume. So it's very possible that we've seen a reversal. I'll feel better when I see a person buy signal come in and we take out that 17-day simple. Let's look at the Nasdaq futures. Even less happy, in my opinion. Well below the 50-day moving average. And, I'm not convinced that what we're going to see here or not see is just this move up to the 50-day over the next 2 or 3 days, which, by the way, would be a pretty nice move. 500 points, 600 points. And then what will it do? It could fail here and come down and retest the 200. There's your bear hypothesis, I guess hypothesis is the right word, also in a person's sell signal. What you really like to see is this, where you had a recovery with a new buy signal, a retest, and go higher. Well, we haven't even taken out the moving averages yet. That's bothersome. You want to see what looks better? Look at the Dow. It undercut the 50 twice, but closed at it on a high volume day on Thursday and took off from there on Friday. Now, if I had to say the strongest of the three so far, it's clearly the Dow, and it's above the 17-day. And if this was what all that would look like, I'd be very bullish here. I think clearly there's some major sector rotation out of big cap tech, which will impact on probably both the S&P and the Nasdaq. But the old stocks, the energy stocks, the financials, the rails, the cars, things that you can touch that are in the Dow, they're doing pretty good. So that's much better looking. If I look at the Russell futures, again, 2 days in a row stopping at the 50, undercut it both days, tested and went below the prior low and finished above. Again, if I had to be bullish or bearish here, I want to be bullish. So Dow leading, Russell second, S&P third, and the weak sister right now is the Nasdaq. And here we have the VIX futures, and you could see they failed at the 200, which is good for the bulls. And the dollar is moving up, which is potentially going to become troublesome on the stocks. Now, often, I don't regret doing this, so let me say this is something else. One thing I like to do is, I'm going to call this here the expected move. Futures. I like to look at the expected move. I learned about the expected move from Kaufman on TheoTrade, previously at Thinkorswim rather. And the expected move gives you a predicted range for next week for an index or for the indexes. So let me do this. I think this does all of them. And let me put the expected move on these. All right. So the expected move plays off of the future, the option volatility. And it gives you an idea of what the options traders are predicting as a high and a low for next week. So here is where it closed. So this is the mid-range of the expected move on the S&P futures. Here is the expected move to the high end, and here's the expected move to the low end. If you go back to the left, you could see, if I went far enough back, that often in an orderly market, you will live within the expected moves. And then all of a sudden, the markets become less orderly. And if we look at what happened in the last week or so, this week we stayed within a very tight range. So yes, we can feel good about the market. We started it on this white line on the S&P futures. We had a great day on Monday, sold off Tuesday, Wednesday, Thursday, reversed Friday, and closed up on the week, but a really modest movement on the week on the S&P futures. Next week, predicting higher high, higher lows. The Nasdaq. Now this one was interesting because here was the prior week, and you know, the last couple of weeks have been nasty, right? So 2 weeks ago, we hit our all-time high in the Nasdaq at 13,950 cents. Traded down. This was, I believe, a holiday 4-day week. Then the following week on Monday, which was, I guess, 2 weeks ago. This was 3 weeks ago. 2 weeks ago, we traded down to the bottom of the expected move on Monday, and you really could have expected a bounce from there, but we continue to go down and close well below the expected move. That's an aberration. Last week, we traded right up to the top of the expected move on Monday, and this is when I put my puts on, or added to my put positions, or expanded my put positions, because I was guessing that that was going to be the high of the week. And we could see Tuesday, Wednesday, and Thursday on the Nasdaq sold off 3 days in a row, got well below the bottom. So we went from the top to the bottom and closed above the bottom. What does the Nasdaq predict for next week? Well, more of a divergence between this and the S&P, lower highs, lower lows. I look at the Dow futures. A very sideways week. We opened right above the midline, traded up to the top, traded down to the midline, and closed right below the top. Very different week than the Nasdaq. If I look at the Russell futures, the Russell futures, like the Nasdaq, traded right up and above the expected move. And again, when I see that, and Mondays have been strong, I usually see this pullback. Tuesday, Wednesday, Thursday, traded down to the lower move and closed almost unchanged on the week. If you look at, this is where it closed the prior week. Here's where it closed this week. Very modest move. So the expected moves I find to be interesting to look at, to get a sense of where a market is based upon what the market makers expect. Now, if we look at the weekly markets here, not going to spend much time, but notice the Nasdaq, the Qs are in weekly sells, the Dow and the Russell are in weekly buys. The dollar is not where it was basing before last year's sell-off, but it's come down off the peaks of earlier this year. And the dollar, that's volatility, the dollar here is trying to make a stand. Underneath, what's driving these changes? Well, we're all hearing about the rates. Well, look at the move of the 10-year and the move of the 30. Now, I watched an interesting video from somebody called the Game of Thrones, and they went back, kind of what Ian used to do, and looked at what to expect from past experience when the rate of change and the interest rates have been so high. What I took from it is you have varied outcomes, but typically the S&P will go up along with those rates. But when the rates start to come down, which probably was consistent with the economy slowing down from high rates, that's when the indexes fell. So clearly the big cap tech does not like the rising rates, but banks do, insurers do, and be interesting to see, but you could see both the 10-year and 30-year are way off their recent multi-year highs or multi-decade highs, but they're also pretty much off their lows, which were all-time. Speaking of off all-time highs, you can look, this is kind of interesting. On the left is the Russell 2000. You can see the red, how it's sold off with the AD line. On the right, the Russell 1000. Actually, this week, the 1000 nipped up a little bit. So, but that's not just tech, that's just the largest cap. But if I look here at the AD line of the NYSE, it peaked up with, in green, the diamonds, in yellow, the spiders, in red, the transports. But notice what's lagging here, the Qs and the Russell. Notice the dive bombing of the TLT related to the interest rates. Another extreme move, not on this slide as much, but on the next one, was really a massive up, down, back up on breadth over the last several weeks. On longer term looking, stocks above the 200 reduced again this week. Stocks above the 40 increased. Well, you expect the 40 to move quicker. What moves quickest for me is this 12-week or 3-month new high, new low. This is a Warden indicator, T2121. 2 weeks ago, it was in, we're going to reverse level. Always reverses when it gets to that white line. It shot all the way down here last week. We talked about, man, it's almost oversold. Maybe we're going up. And look at where we are today, getting towards overbought again. So this just shows you the volatility that we've seen in this market. The McClellan, I don't get a lot of help out of this here. I'm looking for extremes on oscillators or summation index. I don't see them. I'm looking for divergence. Well, yeah, we've moved up on the daily. We're still going down on the summation index, but we've had divergence on this for quite some time. No zero line rejects at play right now. Weekly, the same thing. You know, we don't have any of the three here, although we have had divergence, which has been worked over. You know, as long as we keep failing on the summation index, I wonder when this market's going to actually be able to break out and go much higher. Another sign of the bounce from oversold to overbought. Here we ended up on Friday with over 14% of the stocks in the S&P 1500 trading above their Bollinger Bands. That's kind of bullish. 61% of stocks were above the midline of their Bollinger Bands. Bullish. Here's Thursday. 14% of the stocks are below their Bollinger Bands, with 53% below the midline. Bearish. I don't remember seeing this type of bounces back and forth as we've seen the last couple of days or last couple of weeks. I just have a hard time believing that's healthy for the market. Yes, we got some great news from the Senate this weekend. Yes, we got a stimulus bill coming. Yes, a lot of people are going to take that money and throw it into GameStop and other stocks and probably buy Bitcoin, so the markets will probably go higher. But this is not a healthy market, folks. Speaking of healthy market, I've got this head scratcher now about the Hindenburg Omen. So I'm going to spend a few minutes talking about it. And thanks to Professor Robert Minkowski, Dr. Robert, who followed up a note that I posted on the very quiet HGSI board about this. You know, this market feels like we should have a bunch of Hindenburg Omens. When I run this in EdgeRater, whether I run the NYSE, and this was an NYSE I put together last month, so it's still pretty fresh list, whether I look at just the NYSE Commons or I look at the Nasdaq, in EdgeRater, I'm not getting enough new lows to make the 2%. So it's not going to fire off the Hindenburg. Yet, when I look at HGSI, I had a Hindenburg fire twice this week. And we're going to talk about why that matters. Now, Robert shared with me this math and shared that it met the criteria for a Hindenburg on the 2nd, 3rd, and 4th on the Nasdaq, and on the 2nd and 4th on the NYSE. So let me talk about the Hindenburg part of my What Would Woody Say series today. Little hint, one, I got permission to use his slides while he was still alive. Since he didn't retract it, I'll consider that I still have permission. And number two, if you see a white slide with the green, yellow, and red, just assume that comes from a much smarter person than me named Ian. The Hindenburg omen is a strong warning signal for a market top. It occurs when the herd is buying while the pros are selling. Its claim to fame, there's never been a significant stock market decline in history that was not preceded by a confirmed Hindenburg omen. However, 75% of the signals are mainly small corrections. Here is the criteria. These are built into HGSI and EdgeRater. And notice confirmed Hindenburg occurs if a second or more Hindenburg omen signals triggered during a 36-day period from the first signal. Therefore, that chart I showed you shows a confirmed Hindenburg omen signal. Signals from 85 to 2005, a great Woody slide, shows you that 6 out of 23, or about a quarter of time, a confirmed Hindenburg omen shows a significant correction. Notice that even here in 98, only one fired, and you still had nearly a 20% pullback. Interesting. So, 2006, for whatever reason, these things occur when I travel. I don't know why, but they do. I remember I was in France, and I was feeling pretty happy. I was with my lovely wife on vacation away from work. What's not to love? And we started painting Hindenburg omens, and Woody's talking about protecting your nest egg, don't be a hero, raise cash, tighten your stops, all great advice. And you could see as we nearing the top in May, June of 2006, that we painted a bunch of Hindenburg omens. Now I just have the little red at the top. That followed by an 11% drop in the market. We got over 10% down, and I didn't calculate the Nasdaq intraday, but I suspect it was down 12 or 13% from high to low on this correction. So the Hindenburg actually worked, didn't it? We recovered. Notice, to my FOMO friend around the corner, that we didn't go to the moon right away. We had a big recovery day to the 200 here, and we bounced around. Okay. We had a spurious unconfirmed, so not a valid signal, occurred in late 2006. Now I'm in India with the next series in 2007. And gotta remember, I think it was called WCG. I was big in WCG, and in about 3 days it went from $200 to $30 because of a accusation of fraud. And about the same time when my biggest positions died, the market started getting very volatile. And you could see in early 2007, we had a 14% correction down to the 200-day moving average. Both of these went to the 200-day, and then we bounced. This is when I was in India. Now I've got this figured out. When I see these, I sell. Then, this was the earlier one. We got back actually to new highs, and then look what happened at the end of 2007, October and November. We broke down hard, and that was the Black Swan event. Here was 2018, where in February we had a sell-off, and then we had a bigger one here towards the end of the year. So we used to see these things. We haven't seen a HINDY or a collection of HINDYs since last February. Market tone, EdgeRater using HGSI data, Notice that back here on the 25th, we had a volley of kahunas to the downside, and we left a green bullish market into a more choppy one. On Friday, we had a series of blue kahunas or big moves to the upside, reversed the red to yellow, but we're still choppy. Are we having a changing of the guard? We might, but I think it's still too early. Another horrible week for growth, which doesn't help me. That's why I have puts on Amazon since 3,300, and I still, up until Friday, I had a lot of put coverage on growth stocks, indices rather. Here is the Edge Rater warehouse report. It looks at EPS rank from low to high and return on the week using the data from a week ago. And you could see the lower the EPS rank, the better the return. It looks at relative strength versus return. Stocks with low relative strength outperform. This is market rotation. This is junk off the bottom. I guess they're value play because they're cheap and they're down compared to the past. If you take EPS, relative strength rank, and group rank, 0 to 99, add them together, you get ERG. What do I see here? Again, I ignore the head. I ignore the tail because the number of stocks in light gray are very small. But I see a move from between 0 and 5 on the low ERG stocks to minus 10 on the high ERG stocks. So this was a very bad week again for growth. So if you look at, for example, the S&P 500 was up 0.86. This in gold here or orange, these are the IBD indexes. Minus 2.5 on the weekend review. Market Smith was minus 3.2. IBD 50 was minus 3.62. A combo of a bunch of IBD index was minus 3.92. I didn't fare any better if I just went, and this is bad because this will be TQQ long, even though I'm shorted, so it makes this number hard to interpret. But I can tell you I didn't have a great week, although I didn't have a really bad week because Monday and Friday saved me. After a really bad Tuesday, Wednesday, and Thursday, you were probably the same. But growth stocks were tough. Sectors were mixed. We still got strength, and maybe energy and financial leading for a long time should be good, but we still have a lot of weakness in this market. Let's look at the Edge Q tools very quickly. Most important, when you look at Friday, all the sectors were up. If you look at industry groups, 97 were up and 90% of stocks were up. The amazing thing is you can just see the buckets right here. You went from a negative stance on Thursday to a positive stance on Friday. You went from a lot of stocks below the buckets on Thursday to a lot of stocks above the buckets on Friday. Very rapid move. And you can see whether I look at 5-day, 10-day, or a month, it's a positive picture there. So we had some weakness midweek, and you can see the 5-day average still was very bullish. If we look at how the indexes or the sectors ended up on Friday, energy remains up on top. How long will this go? No one knows. Clearly, that's a back to work play as people will get in their cars and off of Zoom. So oil will go up and ZM will go down, which it did this week. Materials, interestingly, with dollars rising, the materials actually were the second best group. Perhaps some of that was related to firming up of copper again, steel, and other things you can hold. Perhaps as the interest rates go up and concerns of inflation go up, you want to own things that will go up with inflation, things you can hold. I like to take the top two sectors and I run the industry groups there, and you can see these are the industry groups in energy and materials, and you can see the lead here is oil, gas, drilling, copper, equipment, services, steel, exploration, and production. I then took these 5 and I generated a list of stocks that were in these groups, and then these came out as some of the most undervalued opportunities. Canaries in the coal mine, ugly. I mean, this thing rolled over. It's in a weekly bond go down. These are the calculated Hindenburg omens. We've broken below the 50 person sell signal. We have pocket pivots to the downside, which is an HGSI invention and not necessarily recognized by the eminent Gil Morales, another one of my buddies, although I haven't seen him in a long time. Great guy. You know, this blue dot dash thing here, which I hardly ever talk about, it's a 100-day moving average. Interesting, it pulled there and stopped. Big bottoming tail, looks like it wants to go higher. But what we don't know is it going to fail at the 8-day? Is it going to fail at what will be a descending 17-day? Will it fail at the 50? Or is this truly the beginning of a new bull run? I'll go with the it's going to run up and fail vote, but we'll see what happens. Know your news and earnings. There's no such thing as little news these days. Employment matters. But the big thing's not even in here. It's going to be the stuff related to the stimulus bill. Now, you would think, and I have to put my bet on it, that the stimulus bill is going to cause the futures to shoot up on Sunday. I saw an interesting thing on Twitter, and it basically talked about how everybody's going to get $1,400. Well, that's not everybody. But if you take the 1.9 trillion of the package and you divide it by 330 million population, it was $5,750 per person cost. So we're basically would have been better off, I think, giving a $700 million stimulus and giving it and dividing it up to the 330 million people and let them have the money, because they're the ones who are going to have to pay it back. We are mortgaging my unborn grandchildren's future, as well as your grandkids and others, with all this debt. I get it. I feel bad for the people that need it. And I'm not trying to be political, but boy, oh boy, interest rates will never be able to go up because we can't afford the debt service when they do. Lots of things, earnings this week. As I look through, I rub my foreheads. I don't have a whole lot to worry about this week because earnings have been brutal. Some things have been great, and some things have just gotten dumped. And without a whole lot of rhyme and reason, if one of your stocks or more have earnings, it's a judgment call to hold. It's bad judgment to not know when your stock's earnings date is scheduled. I know a lot of you made a lot of money following along with me with my Scott Synthetic. When I take a Scott Synthetic, it's a combination of a long call and a short put spread. Those are two bullish positions. If the market goes against me, that means I've got two positions I can lose on. Now, you've seen me do the math, and you know that it's cheaper to get into that position than buying a call, and it behaves like a call with a little bit more downside because of the delta in the strike prices on the put spread that you're short. When I get nervous in a market, and I've been nervous for weeks, the first thing I do is I close the short put spread. All right? Those things I hate when they go against me. So it's not a bad form to take them off when they lose, when you made 50% on them. If it's you didn't take them off and now they're way above the current stock price, meaning you have max loss, you got max loss. I mean, you got 2 more weeks before the next ones expire. If they're cute, if they're monthly, you might hold on to them. But you got to manage those positions. You don't hold those into earnings. You don't, unless you know what you're doing, and you don't hold them into a major market correction. Market thoughts. It was pretty amazing at 11:30. Thank God I was sitting at my desk and I was able to cover my, I mean, big put positions on the major ETFs. The Nasdaq, in the semis end of the week as the only down leading indices, but the semis actually led to the upside on Friday. Currently, the Nasdaq 100 and the Semiconductor, the stocks are down between 8.7 and 10.7 off their highs. Clearly, the market feels like they want to go higher. I showed you this in the indexes. I should have said thousands of stocks have green candle lows, hammers, other reversal signs, many at a low jump signal. News flow on Monday will be supportive, I believe, but that's Monday. And although I see reasons for bullish enthusiasm, I'd still be careful. I might put my stops below the Friday lows, even if I start chasing, because if they take out those lows, the whole premise of why I'm taking the trades are over. What do I think Woody would be saying? I think Woody would be talking about the Hindenburg Omen. It could be over. We got the correction that we needed to satisfy it, but we could have more pain to come. He would tell you to not play snakes and ladders with your nest egg. It's okay to nibble, but wait for a follow through day or Eureka signal. There was an excellent IBD, Marcus Smith, and leaderboard. They called it a seminar. It was a sales webinar today. And, they talked as well about not jumping all in right away. Now, I'm going to build my box list and look for box stocks breaking out. And I would add, beware FOMO. This market is still risky. My plan began with reversal Friday. I covered my large short put positions. I started to add some to my existing positions that I thought were at good buy points, big hammers, and started building my list to go long. I will deploy some of the cash I took off the board, but I'm not going all in without a follow-through day. So that was a lot of words, and I hope you don't mind me throwing in some of what I think were some critical learnings from Ian Woodward, and I hope that you enjoyed it, and I know I'm not the only one that misses the old guy. All right, so I built this very easily. It's very easy. I wanted to look at the major indexes, so I just took Major Market Plus, and I looked at 5-day change and 1-day change, which is already there. But I looked at days since 52-week high, okay? And then I looked at how far off the 52-week high we are. And when you look at the Nasdaq, it's off 8.8%. Semiconductors are off 10.7%. FANG is off 12.5%. The IBD 50 ETF is down 12.9%. Biotech is down 13.7%. You get to some of the ARC funds, the Israel Innovation minus 20%, ARC Autonomous Tech minus 21%, ARC FinTech minus 21%, ARC Next Gen Internet down 23.6%, Genomic minus 26%, Innovation minus 26.7%. So if those are the kinds of stocks that you buy, and clearly those are the stocks I talk about, you got hammered. So you got to have some flexibility, and maybe it's time to start looking at something besides growth. That's hard for me to do. That's my world. But I've been buying things like Ford, adding to my Bank of America position, getting deeper in energy with a big position in Gush, PDCE, and FANG, not FANG stocks, but Diamondback Energy and Halliburton. I have some steel, I've got some ore, I got some copper. So I've tried to move my portfolio out of just tech. But, one of these days, tech's going to reverse and it's going to go up, and I don't want to be left off that boat either. So I'm still keeping my eye on it. If I look at Major Markets Plus, and we put on the top-down review, the strength of the market on Friday was clearly S&P 500, 100, Nasdaq, NYSE, all were good on Friday. But as we talked about, Nasdaq was a turnaround play. Most things had challenging Tuesday, Wednesdays, and Thursday. Let's take a look at some of these. Now we're going away from the future market, and we're looking at the cash market. S&P 500s, again, here are my Hindenburg omens. And just because I want to, let's go back to February last year and look at how many Hindenburg omens we saw. We saw in Hindenburg omen occur here, and the market really didn't do anything. We saw more HINDYs here, and the market continued to go sideways, more Hindenburg omens, and then ultimately the market broke. Here's some Hindenburg omens, small correction, a series of Hindenburg omens. This is 2019, a deeper correction, but a correction. I pay attention to these, but they don't all mean a whole hill of beans. And reality is we've already dropped enough that maybe we've satisfied them. I look at the S&P 500. I've got a hammer sitting on the 50-day moving average. I've got a kahuna underneath it, coming out of a squeeze. The weekly bond of the person signal are negative. I'm right about the 10-day exponential, a little bit above the 50 at the close. I have no issue going long S&P stocks based upon this chart. Look at the weekly, kind of a doji indecision day. But don't forget, the body of this past week was inside the body of the prior down week. So we haven't broken out. We haven't said the coast is clear. We haven't said load up the boat. It was a positive day on Friday, and we probably got a couple more positives to come. But until I take out this high up here, I don't think I'm going to say it's all clear. I still think we are in a process of topping. We'll see. That is the S&P 500. Let's look at the Dow Jones Industrial. I can't say anything different here. Beautiful uptrend. We're sitting on the 50, above the 17. The weekly bongo is still green. We're a little bit better off here. We haven't closed at a new high. We're close to an old closing high, so maybe we'll take that this week. So as we showed on the futures, the Dow looks better. The Russell 2000 using the IWM. Look at that hammer sitting on the 50, closed above the 50. These red lines are the chandelier stop. These are the Wilder PSAR. They don't go bearish as they are without a pretty big sell-off. So could we run up to the 8 or the 17-day and fail? Absolutely. When is it all clear time? Probably when I'm above here, and certainly when I'm above here. Right now, it's a nice reversal candle. If I look at the Nasdaq, the most worrisome, why? Again, nice hammer, green candle low reversal, that's good. Look at the hammer, the bottoming tail on the weekly. I still got a chandelier, an 8-day exponential, a 50-day moving average, and a 17-day moving average for me to get above all those potential sites of resistance. This feels to me like a pause in the downtrend. I expect a multi-day rally, but I'm not sure that we will go on to new highs. Clearly, I can change my mind anytime I want, and maybe we open up so high on Monday that new highs will be approached. To me, we've rolled over, and the next rally up on this is a bear market rally, or maybe not a bear market, but it's a rally and a correction. Not over yet, could be, but I need more proof. If we look at things that bother me, look at FANG. Yep, great hammer, well below the 50. Here's your chandelier stop. I love to see it break out above that 17 and go chase new highs. That would make me feel a whole lot better. Right now, it's in a downtrend. Lower lows, lower highs. Lower lows, lower highs. Let's change it. Let's look at the IBD 50 Innovator ETF. Lower highs, lower lows. Lower highs, lower lows. Yes, a beautiful hammer. Big bottoming tail, but also a topping tail on the weekly. Well below the 50. Until proven otherwise, I have to get above that 50 before I don't think that 50 is resistance and it turns around. So what do I think is going to happen? Let's just use this because it's a nice example of growth stocks that we might own. I think the high road scenario is this. I would love that because I'm still long. I told you that before. I think more likely we see this. And then maybe it goes up or maybe it goes down. And it's also possible it could go up on Monday and go right back down. So I can't call all clear until I start taking out some of these lines of potential resistance. If I look at the semiconductors, well off their highs. Great day on Friday, still below the high of the prior day, so lower high, lower low, still a downtrend, lots of potential resistance for it to get back to normal. I hate selling like a bear. Biotech, what's bullish about this chart? You had an inside day, I guess, with the box there. You did have a tail that touched the 200. Look, if you told me you want to go all in on this, and you are going to load up the boat because you think it's doing this, that is really possible. I'm not saying it's not, but I would be doing this too. I'd be putting a stop right below the current price. And so if you want to be playing some of these recovery plays, go right ahead. But don't let the stocks drop below the low on Friday or Thursday, if the Thursday low is lower. That is a trade. Nothing wrong with that trade. Heck, all weekend long I've been jonesing about LABU, which is just 3X biotech. Why? Same exact story. Put my low, I might even be less aggressive here, and I might put my low right below the 200. Buy stop right above the closing price. Risk probably about 10%. But, you know, this is one that, heck, it just had this huge sell-off. Maybe you can get it back up to the 126 area. But then you got to, you know, you got the 17 going below the 50. You got chandelier stops. Do I think it goes up on Monday? I think it reverses before it gets to the 50. Just make sure you have stops and you take profits as you go, because I could be dead wrong and this market could be on the way to the moon and beyond. US dollar, breaking out. If this was a stock, I'd be all over it. With the bond goes green, person buy signal, multiple pocket pivots, multiple kahunas, breaking out on the weekly as well. And again, strong dollar will ultimately hurt some of the stocks, especially stocks that sell goods outside the U.S. The VIX doesn't show well on this anymore. It's so freaking low because all the reverse splits. But you could see here, Ultra VIX futures are going nowhere. What about gold? With the dollar weak, gold should have been strong. It wasn't. With the dollar strengthening, gold should weaken, and gold looks weak. Lots of bingos here. Eventually, gold's going to stop going down, but I'll wait till I see green bars and higher highs and higher lows before I go chasing. Gold miners, now this is different. Gold miners look like they've sort of started basing here, but still with a lot of overhead resistance. So I'm not going to run out and buy those, but I might pay attention to them. Silver, still dropping. Very quickly, Kathy Wood, everybody loves her. Everybody wants to be like her. Kind of looks like the IBD 50s. This is her innovation funds. We know she's heavy into Tesla. And we'll look at Tesla in a second. So, yes, bottoming tail. Yes, that's a reversal potential. But it's got chandeliers. It's got a 100-day moving average. It's got a falling 8-day exponential, a falling 17, and a falling 50. It's going to take work. Notice this. It's at the low jump bar. Things like to reverse when they're the lowest they've been extension-wise in the last year. Now, I don't normally go and look at the FANG stocks, but I just want to look at these because I know a lot of people own them. And this is the extended FANG. Google, I think Google is the best of the bunch. I think Google is viable right here. You had a breakout, sideways move, mobile breakout from a squeeze, pocket pivot and a kuna. It's in a person buy and a weekly bongo. If this market goes up, I think Google is in good shape, or Alphabet, I guess, if I'm more modern. Amazon, I still got my puts. I was tempted at the end of the day Friday to take them off, because the problem with having puts that are $300 in the money is for the next $300, if I leave them on, that Amazon goes up, I'll break even. So what you want to do is you want to get those puts off when the market's going up. So I'm tempted, but I think I'm going to be chicken, and let's see if we can get above that 200, because lower lows, lower highs, clear downtrend, lots of overhead supply. I don't see a reason right now to jump in Amazon, except it pulled down to its weekly chandelier and bounced, has a big bottoming tail. I'm keeping my puts. Why don't I just sell Amazon? Because I'm long since $450. When I sell it, I'm going to have a lot of taxes. I'll probably sell them this year because we know they're going to have to raise capital gains taxes. I'll probably buy it right back, but I just leave puts on it and I trade around it, and I can make money even though it goes down. Or set it a better way, I don't have to lose money even if it's going down. Don't like Amazon here. Maybe tomorrow it changes. Apple, it's in a downtrend. It did have a green candle low. It is below the zero line. It's a minus 100%. This is when stocks bounce for me. So I got to put Apple in the interesting zone, but I'm still don't think it looks great. Baidu, interesting. Pulled down to the 50 and bounced. I kind of like this one better than Apple or Amazon. It's above the 50, nice reversal candle. Again, still in a downtrend. Lower lows, lower highs. Bookings, trying to reverse here. Facebook, another one that looks compelling. Facebook is squeezing on Friday. It had a mobile breakout from a squeeze. Pocket pivots, kahuna. If I look down here, it's just below the 50. I might put a buy stop above the 50. Keep in mind the chandelier is probably $10 away, and that could be a target or a resistance. But this looks like it's setting up to go if the market takes off. Netflix pulled down to the 200. I just don't see anything exciting there. I don't know what the next catalyst is. And then here's the problem in the market right now. Tesla going up is awesome. Tesla is a big part of the S&P 500. It's a big part of the Nasdaq. Big part of the Nasdaq 100. It's a part of the extended thing. The problem with Tesla is it's a big part of those. And Elon came out and talked about Bitcoin, sort of levered the price of the stock to Bitcoin, and then a week later, I know he's one of the smartest people in the world, but why would you tell us that your stock is tied to Bitcoin and then a week or two later say Bitcoin's too expensive and it's overpriced? Because that's what tipped off the market, and that's what tipped Tesla in a downtrend. Lower highs, lower lows. It's in a downtrend. So right now, in fact, let me go pull something. Let me pause for a second. I like to read a lot from smart people. This is some institutional research that I follow called turning point analysis. I just want to go down to the bottom here, not giving away anything here. And I also got permission. This is an uptrend. Higher highs, higher lows. You put the line underneath. You want to buy it when it touches it and bounces. This is an uptrend that fails. You want to short it, and typically I want to short it not when it goes through the moving average, because that's a sucker bet. I want to short it when it fails on the first retracement. This is a downtrend. I want to short it every time it retraces into that red line. How hard is it to buy the downtrends and make money? very hard. This is a downtrend. This is a breakout. This is the retest. And I want to buy that retest. So I am looking predominantly for those four patterns, okay? How is this? Which one of the patterns is this? Okay, in my mind, it's this. And until it takes out, I'm no artist. This is not my forte. I mean, there's probably a line in here that until it takes that line out, we're in a downtrend. So Tesla, this could be a great place to buy it, but it's lower lows, lower highs, it's in a downtrend. So I don't see, except for Google 1 and Facebook 2, a lot of compelling buys there. All right, very quickly, I know you're tired of me talking. I'm tired of talking too. If I go to 07 industry groups and I look at those moving up, I'm going to look at those very quickly tonight. I've got 56 to the upside. Yes, short term, I'm bullish. I've got 0 to the downside. Well, that's a big difference. On a more intermediate term, 5 days, I got 67 to the downside, and I've got 35 to the upside. So I'm not sure that this isn't a counter-trend rally that we're going to have, and that stocks are going to rally, and these could be pretty big moves. From this up to that trend line, it's a 17.6 move in 3 days. What percent move do you think you're going to get out of Tesla? The problem is it's already had much of that move. If we go from where it closed up to that trend line, it's still 9%. For us to get from this bottom here back up to the 50, that's a 43% move. Those don't happen overnight. Sorry to tell you that. All right, let's make sure we rank by raw combo. Oil exploration and production. Just look at a couple of these and see if we see anything that's got patterns that we like. These have all run a while, okay? Here's a stock that was in a downtrend. It broke above the 200. It retested here. And what happened? It broke out. That was a good place to buy. It's already going. Could you buy accidental here? Sure you can. You can probably buy a lot of these here if oil keeps going up. They're just starting to get extended. You can see it's at 100% positive. Pays a 2.6% dividend. ConocoPhillips also has already had a big run. Now, will that turn out to be an island gap reversal? 2.9% dividends, got earnings coming in 2 quarters that are big. Devon, this one is broken out as well. These may be early and you may be able to buy them and make a ton of money. It's got great earnings per share growth coming in. It's back to the work economy, and the OPEC is not flooding the market yet. So maybe oil keeps going higher, but these guys have had a big run, also at 100% on the high jump. Marathon, 99% on the high jump. So yes, this is the leading group. I am in this in PDCE and Diamondback, and we'll see. They're all getting extended, and that's worrisome. You can also play ETFs on these guys as well. All right. Integrated oils. Wow. Energy, the first two. I mean, look at Exxon. Here was the time to buy it. All right. Broke above the 200. It retested, and you had a person buy, a kahuna, a mobile breakout from a squeeze. You would have gotten in at 43, 44, and you would have had about a 33% gain already. It pays a 5.7% dividend. Is it worth buying here? It might be. I mean, it used to be a lot higher. I have a hard time chasing it here. It's already had a big run. Chevron, ditto. BP, not as big of a run yet. 5.8% dividend. I think it's on my watch list. Suncor, Royal Dutch Shelf. Petrobras is way below the 200. So maybe you want to look at BP. Banks, they like interest rates. US Bancorp, I like this one. Big run up, pullback, and a move. Higher highs, higher lows. Okay. Was it quick downtrend or pullback? Higher highs, higher lows is what I want to see. I mean, these have all had a big run. You had a little sideways move in PNC. Look how expensive the stock has gotten. Doubled, almost doubled. Look at the earnings per share growth. So I've got one of these. I've been in and out of KRE, Consumer Finance, MasterCard, kind of sideways move. Amex, what a breakout here. Nice 45-degree angle, probably moved too far to buy it. And potentially you could buy Fidelity, but I'd rather see it FIS break out, retest, and then go higher because this has been in a downtrend. Visa, wow, talk about a tight uptrend. Had a little pullback here, but for the most part, take a look at Capital One Financial. Great earnings per share growth. Doesn't pay much of a dividend. So there are places to buy. Oil and gas services. Halliburton broke out on Friday. What was that 8% move, 7.97% move, mobile breakout. Kahuna. This and Schlumberger are the leaders. I think this is the guys of Novartin. What was this called? National Varco or something like that. This and Rig are two companies that have been hammered that are starting to eke out. This one broke out on Friday. Earnings per share growth are horrible, but this is a stock that if we go back in time, $50 there, $45 there, $88 there. This used to be an expensive stock. So does that mean this is now a value play? Maybe. So this breakout here looks impressive. It's still way off its lows, but it's near max on the high jump. Schlumberger, like Halliburton, just a red bar. HP, a smaller on the services companies, breaking out here. Mobile breakout from a squeeze and a Kahuna. So you got some interesting things there. Medical devices. Yeah, Second Sight, I don't touch things that move 300%. Think about this. If you owned it the day before, it closed at about $1.50. Traded as high as just about 10, opened at 2.29 and closed at 5.79. I feel bad for the folks that bought it up here, because it had a great day, but not if you bought it at the wrong place. I don't chase those. I can't remember if I saw anything here that I liked. Livanova got some good earnings in 2 quarters. It's at 92% on the high jump, over 500,000 shares. Again, it's too late. You want to buy them down here. Diversified banks, I added to my Bank of America. I still like it here. It will benefit from higher interest rates. It probably doesn't hurt on a higher dollar. I thought USB looked interesting. Is that in this list? I guess it's not in this list. All right. Is it USB or UBS? We'll look in a second. So I still like Bank of America. Packaged foods, now you're talking about, these are defensive plays, consumer staples. Mondelez, multiple kahunas in a row. Person turned green, took back the 200-day moving average, mobile breakout from a squeeze. I bet you're going to see a lot of things that look like this Monday and Tuesday. Doesn't have much earnings per share growth, pays a small dividend. This is a value play. I have no problem if you want to buy Mondelez. It's just not my kind of stock. Say the same thing about General Mills, taking out its 50, just well below the 200, pays a 3.5% dividend. Kellogg, I just don't like these stocks. Tyson breaking out, nah. But these might be the places to be with this rotation. I thought it was interesting that metal mining made the top 10, especially with gold not doing anything, but maybe there's something to think about here. Newmont Mining, great fundamentals. The problem is it's in a downtrend. And when do you buy stocks in a downtrend? You want to see them break above support and retest. I like to see it break above the 200, but that's too far away. Early buy here, probably too early buy for me. Barrick, similar story. Goldfields, a little bit more interesting. But again, these are all below the 200-day moving average. AU. Tech Resources, I like. I still have a position in it. I've been in and out it a few times. Kinross Gold's a cheap gold. I don't see anything that knocks my sock off there. Home builders, there's quite a few nice patterns. Lennar, here's how crazy it is down here. So my house isn't cheap, but I decided I like buying new houses. And I watch Zillow all the time. I drag my wife and the realtor constantly. But if I see something I like, I'm going to buy it. So we found something. We on a Friday put an offer on Saturday. We already closed. Put our house up for our sale in our golf community, and we probably had 25 or 30 lookers. And we've already, it's been on the market for maybe 4 weeks, and we got pretty much our asking price just a little bit below. After the haggling, and that's done. It's things are popping. So out by my new house, there's a very fancy neighborhood that Lennar is building. We're not in that neighborhood. It's called the Prado. And I remember driving out there and say, "Oh, look at all the nice McMansions," to my realtor, and apparently they sold it out even before they built it. So Lennar and others are doing very well. Well, when do you want to buy something like this? Here's your pullback to the 50 with a breakout. Pocket pivot, Kahuna, New John Person buy signal, mobile breakout. I don't know how they win if the interest rates go up, but maybe people are going to be buying more now because they're getting their stimulus. The economy is opening and they want to buy before the rates go too high. They're still low historically. DH Horton looks very similar, also looks interesting. KB Home, Pulte. So another way of playing it would be something like ITB, which is a home builder ETF. All right, so looked at a bunch of them. I'm getting tired. I'm sure you are tired of hearing from me. Let me show you how you make the boxes. I am going to go to all securities. I'm going to hit the warehouse view. So I've got 10,026 securities in here. Now somewhere I should have a view that will say something about boxes. I just got to find it. Oh, let me see. Let me just go this way. I'm not sure if it's a view or a filter. So it's box. I'm going to check. That's a filter. Okay. Type search box. And okay. So what I'm picking here are ERG stocks that are box stocks. And the box stocks, I should have shown you this before. Let me show you what box stocks are. This is a long video. I apologize. But you can always turn it off, and I still got to be here anyway, so what the heck. I'm just pulling it up on PowerPoint. That's another thing that Ian taught us. And I can't even reproduce his amazing accent. I've given a lot of presentations over the years. Basically, you have the y-axis being annual earnings over the last 5. The x-axis is current earnings growth rate over the last 2 quarters. And then the boxes are formed with these three different rates. Box 1 would be quarterly growth rate of 100%, annual of 50. If it's growing 50% a year, it's going to double in 1 year. Law of 72s, just take the blend here, 75. 72 divided by 75 is, it's a little bit less than 1. Or 75 divided by 72 is less than 1. But about 1 year for box 1, 2 years for box 2, so on, or box 2, box 3, 2 years to double for box 5. Turnarounds would be stocks that stub their toes on the annual side but are really growing fast. But it turns out that these boxes are really good. And just to give you a hint of them, this was looking back to 9/1/2010 was when we decided that the market had bottomed and we were going to pick box stocks. And then if you look at what happened between 9/1 and April 29th, looking at higher stocks boxes, the S&P was up 24%. But if you look here, you could see on the results tab, box 1 was up 125%, box 2 was up 109, box 7 106, and so on and so forth. That every box average was up a minimum of 2 and a maximum of 6, or 5 rather, times the S&P. So off of bottoms, we want to do box stocks. And I could show you over and over again that the box stocks work. So it says right here, might be a good time to create a box list. So I'm going to take that filter at 240. Let's see what's in that filter. Last close greater than 5. 90-day volume greater than, is that 1 million? So big stocks. I don't know what am I saying here? Oh, I don't want that. Do I? That's not the one I want. Let's keep looking. Stocks. And I want ERG, price and volume, $2, 250,000. That's the one I'm going to use. I'm going to hit OK. You actually should have that one. And that takes my 10,000 stocks down to 145. And hopefully my computer is not going to blow up because I've got so many things going at one time. Okay. Now I am going to open up the little slicer here. And I am going to look for boxes. Oh, I got to remember where I put all this stuff. It's going to be in C, users, main user, whatever you are. I think this is where it's at. Where's my app data? All right, I got to change this. I'm going to hold this for a second so I can go find it. All right, I had to turn on hidden files. So if you don't see this, look at your hidden files. So I'm going to open this up here, load custom. And where I'm going to find this, I'm going to go in my main drive. I'm going to go into users. I'm going to go into my main user directory. I'm going to go into app data. I'm going to go into roaming. I'm going to find HGSI. I'm going to go into user. I'm going to go into slices. And I'm going to search slices for box. And what you're going to find is HGS box right there. Okay. So it took those 145 securities, and it says that 51 of the stocks that are above 240 ERG are not in a box. That means that 90 some are. Down here, it's going to, I guess I screwed that up, didn't I? It's going to tell me what stocks are in each box. Well, I'll show you what you can do that's really cool. Let's go into my user group and let's call this HGSI boxes 3.07.2021. We're going to call it Biden stimulus bottom. Now, I don't know it's the bottom, but maybe it is. And I'm going to hit OK. Now I'm going to close this down in a second. Yep. And I'm going to go into my designer here, into my user groups. And I just formed a new group. And in that group will be the stocks that met the different boxes. And another thing that you can now do is you could, I'm just going to pretend here because I just figured them out. Let's say we did these boxes a week ago. We could do a group performance analysis. We can go find that boxes group and make sure all of them are checked. Hit OK. And we could do this from February 26th to March 5th. Hit OK. I'm just call it backwards 1 week because it's about forward, not backwards. And now let's see what we got. Now remember, you want to buy these on the bottom. And these are high growth stocks, so they fall like rocks. So they had a lousy week. Of course they did. We want to buy these things on the bottom. But what you can do going forward is you can look at how the various stocks in the boxes, because typically the next big winners are going to come from the box stocks. So on that note, I'm going to say goodbye. Trade safe. Don't let FOMO cause you to go all in on a market that's potentially going to reverse. Don't wait. Don't give up your nest egg. This market feels like it's going higher, but ask yourself this: are we closer to a top or a bottom? Have a great one. Thank you.